Welcome to Jeff's World, the weekly 30-minute show where our goal is to help you make more informed investment decisions. And we're going to cover key risks and opportunities for investors tied to developments around the world. And we're going to take your live questions from the chat on YouTube. So you can ask us what's on your mind at any time. You just have to enter it in the chat and we'll get to those questions in just a few minutes after we share some of our latest insights. Now, we've got a lot to cover, but first, we've got a few required disclosures before we get started. We don't know you personally, so we don't make personalized recommendations, but we do talk generally about the markets and the sectors and the areas of investing we think are likely to perform well or poorly and why, though we don't provide an outlook for specific stocks. And things can and do change, so our outlooks are subject to change as well. And of course, investing has risks, and international investing has unique risks like currency moves, so please keep all that in mind. Now, as is the case every week, I'm joined by Michelle Gibley and Heather O'Leary on the global strategy team at Charles Schwab. Good morning, ladies.
Good morning, Jeff. Good morning, everybody.
Good morning, Jeff. As usual, I'll be watching the chat and any your client questions closely, and so we'll get to those in a little bit. Jeff, can you kick us off with what you're watching this week that might move the markets?
It's a big week, Heather. On Tuesday, President Trump's biggest tariffs, those on Mexico, Canada, and China, are planned to go into effect after a delay a month ago. If he goes ahead with those tariffs, average U.S. tariffs would jump to rates we haven't seen in decades. And the longer they're in place, the greater the risk to many U.S. businesses, inflation, and the economies of Canada and Mexico. So we'll certainly keep a close eye on that. On Friday, economists expect a net gain of 160,000 jobs in February. That's similar to the 143,000 we saw in January, along with a rise in the unemployment rate, potentially impacted by Trump's executive order that froze federal hiring and funding. Some of that was reversed, but certainly there may be some lingering effect there. So we'll be watching for that at 8:30 a.m. on Friday morning. Now, we also get inflation. I'm sorry. We get an ECB meeting this week, which is focused on the inflation picture in Europe. So inflation is around 2% in the Eurozone, and the ECB is widely expected to cut rates by another 25 basis points on Thursday. The market's going to be looking for any signs of a pause in the series of rate cuts by the ECB at their next meeting in April. Now, the market expects two more cuts to follow this year, bringing the policy rate down to 2% by year end, by basically half of what it is in the US. And we'll also get a glance at the economic projections of the ECB staff with those looming prospects for U.S. import tariffs on European goods. So a lot of things to keep an eye out on Thursday as well. And then on Monday, today, we got China's economic data showing some improvement in manufacturing. We'll have to see if that follows through to services with a rise in housing transactions after the Lunar New Year holiday, and partly by a one-off boost to spending from the success of the top grossing film of all time, Nacha 2. So we'll be interested to see how that shapes up. It's always interesting to see, we tend to watch economic data. We watch these long-term trends and how they kind of roll through on a cyclical basis. And then you get kind of these one-off things that can kind of shock the see what impact that might have had on the services sector. Now, the background for this week remains positive in the markets. We still see strong outperformance by European stocks this year. I mean, international stocks are up 2% today relative to a flat to down market for the S&P 500. This relative outperformance in European stocks is being aided by a really robust earnings season that's helping to offset the risk from U.S. tariffs. Citigroup data shows that the number of analysts raising profit estimates is much higher than typical for this time of year, and that's different to the pattern seen in the U.S., where projections have been reduced since the end of 2024. You can see it here in that highlighted section. Normally global earnings revisions by analysts kind of move in sync. It makes sense. Companies are global, right? They generally have global sales and global operations. So if they're coming down, they tend to be coming down in Europe as well as in the US. But we've really seen a departure here so far this year with week after week after week, upward revisions to European companies, downward revisions to US companies. So an interesting backdrop here as we think about this week and the prospects union speech tomorrow. I think improving earnings and economic growth generally trump tariff concerns. See what I did there? But there's a big tariff event this week, right? So last Thursday, President Trump said that the 25% tariffs on imports from Mexico and Canada that were delayed a month until this Tuesday will take effect, as well as another 10% on Chinese goods, for a total of 20% new tariffs on Chinese goods this year. Now, President Trump will give a State of the Union speech tomorrow night, just hours before the tariffs are to take effect. He kind of tweeted to that effect, or Truth Social posted to that effect just hours ago, talking about expect big things. So we don't know. I mean, the market's reacting to suggest maybe there are some signs of those tariffs. Maybe Mexico and Canada have done enough to delay the tariffs again further. Just looking at this table we've kind of put together, just sort of summarizing what's going on in terms of where we are in the tariff timeline. And you can kind of see, so the gray box up front, those have been implemented. And now we're up to that March 4th deadline for the next set of tariffs. And we'll have to see whether those are put in place or not, or delayed. Again, sort of cryptic remarks from the president here in terms of his social media posts with regard to whether that will happen or not. We heard up until the day before that they were going to go in place on February 1st, and then they didn't. We heard they were going to go in place on day one until they didn't. So the market is still mixed as to whether this is actually going to go through on March 4th or not. Of course, that 30-day extension ends on Tuesday, and if it does go into place, that would be pretty big. We have not seen tariffs this high on American imports for many, 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 many decades. It's possible that Trump's professional trade team, knowing this, which is just setting down to work, right? U.S. Trade Representative Greer was confirmed on February 26th. That was a week after Commerce Secretary Lutnick. They may favor another delay now that they're just in place and able to kind of assess the situation. But I don't know, he may choose to follow through, at least temporarily, to make good, at least good on this threat. The Canada and Mexico tariffs were initially signaled as being temporary, though, intended to secure cooperation on immigration and fentanyl flows. The president did tweet over the weekend, I can't remember what day it was now, how tremendous progress has been made on reducing. I think he said that the smallest number of immigrant flows into the U.S. in years, I think in February. So kind of indicating a little bit of a signal there that maybe there's another delay, but who knows? There's certainly more work to do. In our surprises for 2025, we published late last year. We stated one of our top surprises, in fact, it was the top surprise, that Trump may actually implement tariffs that are higher than expected, but then quickly drop or reduce them. So far, that's been the case. Even before they were implemented, they were announced and then pulled. But again, even if those tariffs go through, they could be reduced fairly quickly on further progress that Trump seems to be noting with regard to immigration and fentanyl flows. Remember, the biggest exporters from Mexico and Canada to the U.S. are not Mexican or Canadian companies. They're Ford and GM. So a desire to make good on his threats is balanced by his desire to have a legacy of restoring U.S. manufacturing, which suggests he isn't prepared to throw the North American economy, including the U.S. auto industry, into chaos. So if he does move forward with across-the-board tariffs, I wouldn't expect they'd be in place for very long, given the serious implications for U.S. manufacturing giants. It's more likely that he will allow the tariffs on China to go into place, maybe in part to provide leverage to start conversations around a broader trade deal that might include TikTok. But okay, what does this mean for markets? So for weeks, U.S. President Trump has been threatening more tariffs, and for weeks, markets have just basically shrugged. I mean, yeah, U.S. stocks are flat, but international stocks have done well. Mexican stocks have done well. Canada stocks have done well. Chinese stocks have done well. We've generally seen some progress there. In fact, I think European stocks are up now 6 of the last 7 days. The renminbi, China's currency, the Mexican peso, the Canadian dollar have been pretty steady. So it's interesting to see how this is shaping up. Even inflation expectations measured by the TIPS market have barely budged. I mean, in short, markets are betting that Trump's tariff threats are empty, and that could mean stocks are vulnerable to a pullback if Trump follows through and implements that full tariff threat. The market will expect more will follow if we get that 25% tariff. And remember, we've got 25% tariffs on steel and aluminum tariffs set for March 12th. And 3 reports from trade-related agencies due on April 1st. So even if these tariffs due tomorrow don't go into effect, there's still some headline tariff risk to come. Michelle, one country where the economic game is still unclear on all this and what's going on domestically is China. What's going on there?
Yeah, coming into this year, China was on the top of Trump's target list, a 60% day one tariff threat given. So far, despite these threats on all the countries, the only new tariff so far that has gone into effect has been on China, 10%, and then another 10% increase set to happen tomorrow. But the absence of the 60% tariff and talk by Trump of a potential major deal has bolstered sentiment and hopes. In the past, Trump has talked about the possibility of increased Chinese investments into the US, but an executive order from the White House last week indicates maybe a move in the opposite direction. So there was an America First investment policy last week that's similar to the America First trade policy that we heard about day one. It laid out the potential for curbs on both inbound and outbound investment. So into the US by China, and then by the US into firms into China, among a list of other potential restrictions. Now, there's no timelines on this executive order, and it's possible it's just another layer of leverage that Trump will use in negotiating a grand bargain, but it's really not clear at this point, Jeff.
Yeah, it's interesting, right? Because Trump has been saying, hey, he wants these Chinese companies do large scale investment in to sell to U.S. customers, and yet signed an order that basically restricted that. So yeah, could it be leverage? Could it be? Maybe he didn't read it. I don't know, but we'll have to see. But beyond the tariff implication, Michelle, the next major event I know you're studying very carefully and preparing for is China's National People's Congress on March 5th, or I guess the night of March 4th here in the U.S. So sticking with China, Michelle, what are we looking for specifically coming out of that meeting?
Yeah, sentiment by investors in Chinese stocks really got a boost at the end of September when the government appeared to shift toward reducing downside risks in China's economy. And these moves were primarily monetary stimulus and then promises of additional fiscal stimulus to come later. Since then, sentiment has had some pretty dramatic swings. Hopes were dashed in December after a series of policy meetings failed to provide fiscal stimulus. And then in January, we got a boost to sentiment, a little bit different one in this case. The DeepSeek R1 AI model really gave a boost to sentiment in a recognition of the ability for Chinese companies to innovate and potentially adopt AI into business operations and lift earnings growth. So far this year, Chinese stocks are up 13%. So this week could be another moment of truth. How much fiscal stimulus does the Chinese government provide? Will there be additional measures to boost consumer spending? And then what will be the growth target for the year? Now, last year, the on-budget fiscal deficit was 3% of GDP and a growth target of around 5%. As I said earlier, in September, the government gave the expectation that that fiscal deficit was going to expand this year. But, GDP growth was not too bad in Q4, 5.8% quarter over quarter analyzed, 5.4 year over year, and that lifted the full year to 5%. So there doesn't seem to be a lot of urgency to provide a bazooka of stimulus at this time. Last year, we also saw measures to refinance local government debt. And already this year, there's rumors again of a bank recapitalization for large banks. But given the recent gains in Chinese stocks, they've been primarily sentiment driven. So this stimulus or not this week by the NPC, stocks could add to gains if it's sizable and concrete measures. But there also could be room for disappointment and prompt another bear market in Chinese stocks, which seems to happen about once a year, Jeff.
Yeah, right. A lot of volatility in those markets. Michelle, what do you make of the difference between domestic stock market indexes in China, which are, some of which are flat for the year, and Hong Kong internationally traded shares, which are up, pretty good, like 15%. What do you make of that?
Yeah, I think that most of the rest of the world, I don't know that Chinese investors really ever gave up on the Chinese economy, but the rest of the world seemed to, talk about it's uninvestable. We heard that over and over last year. So we're seeing a little bit expectation of, hey, maybe there is room for these stocks to rise by the rest of the world. That's what's happening offshore. And there's also a lot more tech companies, tech weight in the index in offshore markets.
Okay, yeah, makes sense. So, although tech maybe hasn't been such a great performer this year, but we have seen, oh, well, I guess the DeepSeek and that kind of thing has generated some activity in China. But yeah, money moving back into Chinese equities from overseas markets seems to be supporting those international. All right, well, let's shift back to Europe. So the European Central Bank meets Thursday. There's a lot happens between now and Thursday, but they're going to meet on Thursday. A 25 basis point cut seems to be completely baked in. I think the market's pricing in a 100% chance of that. Whether you think markets are pricing 100% chance of anything is a separate issue. But what are investors going to be paying attention to, Michelle, in that ECB meeting and the readout from that?
Yeah, if they cut by 25 basis points as expected, they will have cut by a total of 175 basis points since they started last June. And so that puts the deposit rate, their benchmark rate, at 2.5%. Investors are going to be paying attention to any hints that that rate is still restrictive and therefore they have more room to cut, or if it's closer to a neutral rate that suggests the central bank may be nearing a time to slow down the pace of cuts from every meeting to maybe every other meeting.
Yeah, I think that's going to be the battle, right? Is it two more cuts this year or three? And do they do them right away or do they pause a little bit? It would seem like they have the opportunity to do that. But a lot of it may depend on what comes up with tariffs and how currency moves and maybe the prospects for defense spending in Europe. There's certainly a lot on that. I think, there are lots of ramifications from driven by the US that could impact what the ECB does later this year. All right, finally, before we get to the questions, I thought I'd mention that there are other implications to Trump policies. And one interesting one is a dramatic shift in polling for Canada's upcoming election. We know Canada is going to have an election this year, hasn't been called yet, date isn't set, but it's coming up in months here. And Canada's seen the Liberal Party dramatically lagging the Conservative Party, but that has changed dramatically in the last few weeks. The recent surge in anti-Trump sentiment in Canada has actually given the Liberal Party the lead. So rather than having a like-minded conservative government north of the border that shares many views with the U.S. administration, it may end up with the opposite. So really interesting to see there and what that might mean for U.S.-Canada relations going forward. There was some thought that Pierre Poilievre might be more of a Trump-like figure and those two leaders might get along. But now looking at maybe Mark Carney as the potential, I mean, a lot can change, obviously, as this chart indicates. But Mark Carney would be much more of a technocratic leader, almost a Draghi of Canada, if you will, and be very interesting to see how that shapes up. So lots of wide-ranging ramifications this week, both on the European Central Bank, certainly on China, the tariff issues, and then interesting here as it relates to Canadian elections. All right, Heather, let's move to chat Q&A and see what the questions are.
Terrific. We do have a lot of great questions spanning all over the world. The first question really is poignant. We do have your favorite indicator, the PMI, starting to be released out this morning. Do you have any initial thoughts on what we've seen thus far?
Well, manufacturing is back in expansion. And this is something we've been pointing to for a couple of years that we needed to see to really turn the corner. And indeed, they are following, right? We talked about earlier in this show here how week after week after week after week now this year, earnings for European companies have been revised higher, even as they've been revised lower for U.S. companies. So really turning the corner, and manufacturing is key to that. However, given that there are potential trade risks ahead, there could be some front loading to that manufacturing and the orders and the shipping going along with it. So you worry a little bit about potentially this rebound we're seeing and likely to see in the manufacturing data. Is that sustainable if we see those tariffs put in place, or could that really be a major negative global economy? We'll have to see how it shapes up. Obviously, sentiment is what we're measuring with the PMI. We're not actually measuring things. We're measuring the sentiment on manufacturing and trade. And so far, it's held up, and that's maybe remarkable in the face of everything that's gone on, that we continue to see solid underlying growth in new orders trends, inventories, production itself, all of these things. So encouraging to see. We are seeing some slowdown on maybe the employment side, and maybe input prices in some groups in some countries have gone up, indicating maybe some inflation threat. Certainly in the U.S. that's been the case, less so elsewhere, but certainly something we're keeping a close eye on. Again, a sentiment index, but one that hasn't been rolling over here, given some of the concerns, maybe along with the market, thinking that a lot of these tariff threats remain more bark than bite. Michelle, do you have thoughts on the manufacturing picture?
Yeah, I think there was some room to think that manufacturing can expand a little bit further from here. But at the same time, we don't know how much of the increase recently is kind of front running ahead of tariffs, and if we'll see a little bit of slowdown in the months ahead.
I'll say that, historically, generally with a 9-month lag, the PMI tends to, the manufacturing, purchasing managers index tends to follow the number of central banks cutting or raising interest rates. So generally what we've seen, and given where we've come in terms of the top 14 central banks, the advanced economy, the non-emerging market central banks around the world, where they've come in terms of shifting towards cutting rates, that would point to somewhere around 52.5, 53 on the global PMI, and we're at barely over 50. So it would suggest further improvement in the PMI. So, tariffs may have been maybe holding this back a little bit, but we are in a move where over the next, 6 to 9 months, we should see further improvement in the PMI. That is sort of the base case, economically speaking, from the backdrop that we're in, the interest rate backdrop that we're in, the economic picture. It would take something to derail that, and that's just the risk around tariffs. Our base case remains that it continues to improve.
Thanks so much for that information, Jeff. We do actually have a question, and I'm going to actually address this one to Michelle. What developments have we seen in Germany post-election, and how might that affect the European Union?
I think it's interesting. These America First policies could make Europe stronger. We've got the Eurozone and the European Union. They haven't always acted in unison. They have a common currency in the Eurozone, but they lack a union on the fiscal side. And there's already talk about issuance of common debt for spending on defense. If the U.S. appears to be backing away from support, and that could bring Europe together. In Germany, this strict adherence to virtually zero fiscal deficit could be dropped. There's talk today of additional 200 billion in euros spending on defense and another 200 billion on infrastructure. And Germany has really chronically underinvested in infrastructure in recent years. So this could actually boost their GDP growth this year.
And Michelle, that was separate from budgets, right? So this is like off budget, kind of like emergency spending. So there wasn't that same kind of constraint around, we've got a lot of countries in the European Union that are backing up against their debt limits, and this was something that, including in Germany, which has a constitutional debt limit or a deficit limit. This was like spending on top of that additional spending. So somewhat encouraging that we're seeing this. And one of the reasons why European defense stocks are doing so well this year, up over 20%, those magnificent seven in Europe really trouncing the magnificent seven in the US, which are down 6 or 7% this year. So that's really a big story this year. European providing more for its own defense, the economic stimulus that comes along with that, and the outperformance of certain sectors of the equity markets.
Now, Jeff, do you think we'll see any instability of that, given what could be considered a blow up at the White House meeting with Trump and Zelensky? How do you think that might affect the markets?
Well, I think that prompted an emergency meeting over the weekend among some of the leaders in Europe, and I think Canada was involved with that as well. So you are getting them pulling together and saying, okay, we need to excel. We've relied on the U.S. for a lot of defense. That was sort of the post World War II agreement, and now maybe we need to provide more for our own. So really ramping up support for collective defense in Europe. The UK involved with all of that as well. So much more of a move in that direction, and that just suggests higher spending. Remember, Europe hasn't grown its debt to GDP in almost 20 years, where the US just continues to climb and climb and climb, right? A lot of debt fueled growth in the US, not the case in Europe. They have the capacity to do, well, in theory, they have the capacity to do that. We might like the fact that they're not growing debt to GDP, but it looks like that is on the path for the next several years. And if that's the case, economic growth, manufacturing sector, and earnings should probably respond to that.
And speaking of earnings, one concern that we have regarding the tariffs, do we see any possible supply chain issues either to or from the EU or from the rest of the world with the implementation of new tariffs?
Another great question. So there are tremendous challenges when you now go from a schedule of tariffs that the U.S. Customs and Border Patrol has to implement for shipments coming in, and now there's upwards of maybe 3 million different tariffs in terms of different products. Every country has a different tariff, potentially. Every country and every product group having a different. So you end up increasing on an incredible scale. And now there aren't any de minimis levels at which imports can come in, like under $800 that weren't subject to that. All of it. So this is an enormous amount of work, and I don't know that the CPB is staffed up to do it. I don't know that they have the technology to implement it right away. They've been complaining that they just don't have the ability to do this. So could things slow down dramatically at the borders? So we'll be watching. Do we get container ships backed up at ports? Do we see border crossings with Canada and Mexico really stalled? And then we see long lengthenings in supply chains as everything just has to get inspected. So, paying those tariffs is one thing, but the delays associated with now all those inspections and calculating those tariffs, there could be some. So we'll have to keep a close eye on that, and we'll track that very carefully. We have, major bridge and border crossings data we can track, and of course the port traffic we can watch in real time as well, and just watching, satellite and ship transponders. So we'll keep a close eye on it. I'm not anticipating a big backup right away. We're actually in a period of year where trade and global shipments tend to slump a little bit here in the spring. It's sort of the lowest time of the year in terms of global trade. Not that it's a big drop, but it's a little bit milder than it is, let's say, as we ramp up into the holiday spending time. So all of that will be something we keep a close eye on to see if there are any supply chain lengthening issues. We certainly maybe expect some of those in steel and aluminum manufacturing, so autos, airplanes, those types of things. But broadly speaking, we'll have to see if those spill over to other areas as well.
Now, as a follow-up question to that, have we seen any advanced shipping of goods in anticipation of getting it into the country before tariffs are put into place?
Well, there have been orders placed. So we have seen maybe a little bit ramp up in some categories, but we know that, U.S. steel prices have shot up over 20%, 23.7%. I think what I calculated on Friday, what they've gone up in anticipation of these steel tariffs. Aluminum not, but we have seen a big ramp up in steel prices in anticipation. So if you get your orders in, early enough, maybe you can get around some of those tariffs, and we seemingly have seen that again in just a few categories of goods. We only import 8% of the steel that we use, so I wouldn't expect that to be a huge cost that gets pushed along in terms of seeing it in CPI. But more and more as other products are affected, we could begin to see some of that. So again, this is some of the stuff that we've seen in the new orders component of the PMI survey. And so as we look to get the next update on that sort of around the 20th to 25th of this month, as we get it for this month, it'll be interesting to see. Of course, we're going to get the updated numbers for February out very soon, and we'll have to see how those shape up. But for the most part, we haven't seen a huge surge in ordering. I think, as is the stock market, I think many businesses are convinced that these won't go into place, and that there was no reason to advance order those pieces of inputs. But let's see what happens.
Great. And we have one final question. We do have, countries like Norway and Saudi Arabia who have sovereign wealth funds, and there has been a proposal for a U.S. sovereign wealth fund. How feasible is that, and what can we expect?
Well, most countries that have a sovereign wealth fund are those that have a lot of natural resources revenue, a lot of oil revenue, and they have trade surpluses. So they literally sell more than they export more than they import. And so what they do with all that money they get from around the world, well, they turn around and then invest it in a lot of those countries, in part to, maintain that relationship, but also they're just recycling the currencies that they get. There are very few countries that run trade deficits that have sovereign wealth funds, right? Because you'd have to fund that with debt, and sort of raises questions as to then where are you investing it. So France has one. In general, it's invested very heavily in French infrastructure and nuclear development, and so it's been a place where they've looked to make strategic investments in the French So if something were like that to happen in the US, maybe it would be in investments in electrical infrastructure or in nuclear development as well, or some of those types of areas. But I'm not sure. I'm not sure what the talk is in terms of how that would actually be implemented. I know there's talk about a crypto reserve, but maybe this is a little different in talking about a strategic investment where it's in the U.S. economy and into areas that maybe China's doing and other parts of the world are doing to try and ramp up their competitiveness and try and get energy costs down. Something the U.S. could attempt. There's been talk about that by Republican and Democrat administrations for a long time. Really haven't seen something like that come into play. So it'll be interesting to see how that shapes up, particularly in an environment where the U.S. is already borrowing and spending quite a bit. But I wouldn't rule it out. We'll have to see.
Thanks so much, Jeff. It looks like we are wrapping up today.
Great. Okay. Well, fantastic. It's been another amazing week ahead of us here. I'm just looking over, German stocks are up, wow, 2.6% today. So again, market sort of positioning for what could be coming here, probably largely based on what they expect out of the State of the Union speech tomorrow night. So we'll all be tuned in. Thanks, Heather. Thanks, Michelle, and our producers, Andrew and Gabe, and everyone for the questions and for joining us. Tune in each week at 11 a.m. Eastern or catch the replay on YouTube. Also, be sure to click like on the show and share your comments on what you're watching in the markets. And we'll see you again next week.